Hi, welcome to another ColdFusion video. In the consumer-driven landscape of our modern world, the boundaries of individual business sectors are becoming increasingly blurry. Some examples are understandable, like the hardware manufacturer IBM shifting to investing in software, or Lego infiltrating the film and video game market. But others are a little harder to comprehend. Some companies have realized that one of the best ways to make money is to be in the business of money, that is, the financial sector. In recent times, highly unconventional players have entered the money game. Apple is one with their credit card, but Starbucks is another. Founded in 1971, Starbucks is the most famous name in cafe beverages. But since then, they've managed to use customer funds to launch a clever investment scheme. Investing customer money without their knowledge or even providing any returns to said customer sounds like something that should be illegal, but if it's done in the way that Starbucks has done it, it's very much legal. Coffee shop on the outside and a financial institution behind the scenes, it's so bizarre that it deserves a deeper look. In this episode, we'll take a look at their business model, dissect the mechanics behind its quasi-banking operations, and we'll also see how it differs from the conventional banking system.
You are watching ColdFusion TV.
The key to this clever plan is the My Starbucks Rewards system. Established in 2009, on the surface, it's a simple concept. Starbucks offers a mobile app where you can store value in your Starbucks account. You load up on funds using your credit or debit card, and Starbucks instantly receives the cash. Meanwhile, for the customer, they earn a digital currency called stars, which accumulates with every purchase. Eventually, these stars can be exchanged for food, drinks, or other merchandise. For example, after 10 stars, you get a free drink. And this is the incentive to get customers in. Who doesn't like free stuff? So far, it resembles a reasonably straightforward reward system, only with a few extra steps, but there are some clever tactics taking place in the fine print. While it is marketed as a digital version of a punch card, it's actually a very clever way for Starbucks to invest your money without you even noticing. Starbucks essentially receives an interest-free loan from its vast clientele every time they load money into the reward system. And while you wait to purchase your next coffee, Starbucks is busy earning interest on your hard-earned money. When customers upload their funds to their Starbucks cards, the company invests this money in short-term, low-risk ventures. The return is about 0.05%, but the sheer scale of the customer base means that this arrangement can be very lucrative. There are 29 million Starbucks Reward members around the world. Some estimates say that upwards of $10 billion a year comes through the loyalty program. The value of the system is so grand and so valuable that if Starbucks was a traditional bank, it would rank in the top 2% of US banks by deposit size. Some of these funds deposited by customers may not ever be spent. A 2018 estimate deduces that the company earned $155 million simply from customers who forgot about their cards. Of course, the company isn't so brazen about its inadvertent banking operations. The system is skillfully obscured behind a curtain of customer service and convenience. The customers feel satisfied, rewarded, and none the wiser. On the surface, the reward system seems to be a clear win-win situation, but there is a bit of a grey area. When it's broken down to its basics, the customers who leave their money in their Starbucks Rewards account are essentially giving the company a free loan that can be used to finance their business operations. While it's not technically illegal, it does feel morally ambiguous, almost like the customers are getting the short end of the deal. But people may argue that it's not their life savings in the account and the customers are getting free items out of it, so who really cares? Well, consumer watchdogs do. They note that although the Starbucks model offers convenience, it might also encourage increased spending. They state that the psychology of preloaded cards often leads to consumers spending more than they otherwise would. But from a pure business perspective, Starbucks has virtually found a way to get free money. And after such success, there's bound to be other unrelated companies that are getting in the business of money. And that's what's happening. Everyone from Amazon and Apple to Walmart, Target, and Costco are following suit. These companies have two things going for them: a strong established consumer customer base and a strong brand identity. It's a potent combination where they can mix primary goods and services with financial services. combined with consumer convenience and benefits, the customers are bound to eat it up. Apple entered finance with Apple Pay and partnered with Goldman Sachs to launch the Apple Card, an exclusive credit card to their customers. Walmart launched the Walmart Money Card, a reloadable prepaid debit card, as well as Walmart to Walmart, a peer-to-peer money transfer service. Despite these financial services, these companies, unlike banks, face less stringent regulations, but this may soon change, at least a little bit. Government bodies are starting to notice the trend of financial services coming from seemingly random companies. The Consumer Financial Protection Bureau is leading the charge in the United States. They've proposed new rules requiring companies offering certain financial services, including payment processing and money transfer, to register and comply with user protection laws. Also, some states, like New York, are pushing these companies to obtain a license for providing such services. And it's not just the United States that's taking notice. Globally, countries are recognizing the implications of this hybrid model. In the European Union, new rules are proposed, requiring companies offering specific financial services to be licensed by the European Central Bank. The United Kingdom now necessitates such businesses to register with the Financial Conduct Authority. And in Australia, they must obtain a license from the Australian Securities and Investments Commission. The effectiveness of these efforts remains to be seen. As the boundaries of traditional business sectors blur, an era where something as simple as a coffee shop rewards program can morph into interest-free financial services without customers ever noticing is pretty peculiar. It is strange that a coffee corporation is acting like a bank without regulations. Although now under increased scrutiny from authorities, as long as nothing goes wrong, Starbucks isn't going to be on the radar. But what do you guys think? Do you think Starbucks should be more transparent in what they're doing with consumer funds? Do laws need to be changed? Or do you think what they're doing is absolutely fine as long as the customers are happy? It's an interesting murky grey area, so I'm interested to see what you guys have to say in the comments. Just some housekeeping before I go. I've collaborated with the Australian Broadcasting Corporation's channel for a 3-part series on AI. The first episode is going to be released within 24 hours, so I'll leave a link to that below. Thanks in advance to those who have given it a watch. Okay, so that's about it from me. Thanks for watching. My name is Dagogo, and you've been watching ColdFusion, and I'll catch you again soon for the next episode. Cheers, guys. Have a good one.
ColdFusion. It's new thinking.